Good morning. I have come with the explanation of module 4 where I will explain the differences between capital and revenue. See, I told you first two modules I have used for explaining the basic concepts. What is income, who's an assessee, what is assessment year, previous year, exempted income, features of income. All these details we have learned in two modules, first two modules. Then third module I have used for residential status. Third module itself I have divided into three. First module I have explained theory and one problem for computation of residential status. Other two modules exclusively I have used for calculating the residential status with the help of problems. So I hope that this will be clear. And now this module I am coming with the explanation capital and revenue. Now, why this distinction is important? Why we have to distinguish between capital income, capital expenses, capital revenue income, revenue expenses, capital income, capital losses, revenue income, revenue losses, or altogether the distinction between capital and revenue, why it is important. We know that there are five heads of income, that is income from salary, income from house property, income from business or profession, capital gains and income from other sources. So here you have to remember that capital receipts, capital gains, capital losses are treated under the head capital gains, and revenue income, revenue expenses are treated in the head revenue income from business or profession. You know that other heads of income, salary we will include in the head salary income, house property, income from house property we will include in income from house property head of income. Then income from other sources is like a residual income. If it's not included in salary, house property, capital gain or income from business or profession, it will come to income from other sources. Say for example, gift or a lottery received, dividend received, bank interest, examination remuneration. All these things we will come under income from other sources. So this distinction is very, very important. If you have to distinguish an item, whether it should be treated in capital gain or whether this item should be treated in a business or profession, you have to distinguish this. So that is the importance of this module. Problems will not come from this module, but this theoretical concept is very, very important for doing the problems. So this is what I want to give you as explanation, and I hope that after this module you will be thorough with this distinction of capital and revenue so that you can use this basic concepts while doing the problems in income tax. So income and expenses can be classified into three divisions. One is capital receipts and revenue receipts. Second one is capital expenses and revenue expenses. Third one is capital losses and revenue losses. Now we are going to deal this in detail. The distinction between capital receipts and revenue receipts, capital expenses, revenue expenses, capital losses and revenue losses. You have to remember that if you get a question for examination, you have to write, when you are always writing as a distinction, you have to write it in a table form. Always you have to remember that I have used the short forms for the explanation because in PPT I cannot give the full sentences. So when you are writing the examination, you have to make it as a full sentence and you have to write. So in the PPT what I am showing is some important words I am capturing for my explanation because I cannot use the full sentences there. There is not much space there. So that is what I am going to do, and I am going to explain this module with the help of PowerPoint presentation. So why there is a need for this distinction? Capital receipts and losses are treated under capital gains. Always you have to remember that capital gain we will not be reporting every year. Once in a while only we will report capital gain. See, this is my 28th year of service, but I have reported capital gain only for 2 years. Though I file my returns all the 28 years, I have claimed capital gain only for 2 years. So that is very, very important. You have to remember that. So capital gain, we are not claiming every day or every year. Only twice I have claimed when I sold my house property. So that was the treatment for capital gain. Now we are talking about income from business or profession. I told you we are treating only revenue receipts and revenue expenses. So if you are not clear about this distinction, then it will be, then you will go wrong in the calculation. So revenue receipts and revenue expenses will be there. If a person is doing business or profession, every year they will be reporting that. Whereas capital gain, it's not repeating. Once in a while only they will report that. And you have to remember that the income tax department is giving lot of exemptions for escaping from the capital gain tax. See, for example, I sold a house property and I got a capital gain of 5 lakhs. You know that how you are getting capital gain. See, for example, I bought a house property in 2000 for 10 lakhs. In 2015, I am selling it for 20 lakhs. So my capital gain is 10 lakhs. So the capital gain. Now, if I have to pay 10 lakhs along with my other income, I have to pay huge tax. So there is an option to avoid this. Now, how I will avoid this? Income tax department is giving certain exemptions for that. See, for example, this 10 lakhs what I got as capital gain, if I am investing in a new house property, the entire amount, I don't have to pay any tax at all. Like this, there are certain exemptions available exclusively for capital gains, because government want more and more people to file their tax returns. They want to be transparent in their dealings with the income tax department. So they have to reveal all the income. That is why they are giving more exemptions for capital gain. Now, first point is capital receipts and revenue receipts we are going to distinguish. So capital receipts, you have to see that fixed assets gives capital receipts. That meaning when you're buying a plant or machinery or a vehicle for long-term use or a house property, anything related to a capital asset, it's a anything related to a fixed asset, it's a capital receipt. Whereas revenue receipt meaning circulating assets gives revenue receipts. If you go to a shop, every day customers will be coming there and they will be buying the items. So as the items are sold, they are replacing the items. So it is circulating. Every day they are replacing the items. Whenever it's getting sold, they are replacing that. So that is the revenue receipt. Second point you have to remember, capital receipt, receipt on termination of an income is a capital receipt. Termination of an income, you are not going to get an income from that fixed asset again. For example, compensation received for cancellation of business rights by government resulting in closing down of business. Say for example, this lockdown period. Now you know the disturbance between India and China. So some companies, Maharashtra government, Andhra government, which all where all they got the contract with Chinese companies, they cancelled that. Another example is Indian Railways got a contract with Chinese company. So that also they cancelled that. So these are termination of income. That contract is terminated there. It is not going to work. So it's a capital receipt. Termination of income. If there is a compensation clause, they will get that compensation. So it will be a capital receipt. Now, revenue receipt, receipt on substitution of income is a revenue receipt. For example, a compensation received in respect of stock in trade damaged by a business unit. See, for example, this lockdown period. Everybody was forced to close down their business units for 70 days. It was completely closed down, 70 days. So some of them, they knew it, refrigeration, some of the items, in all of a sudden they were asked to close the shops. So they suffered a loss. That will be a revenue loss for the business unit because it's a substitution of income. If the shop was open and if they are able to sell that item, it will be a revenue receipt for them. But this is a damage for that item, whatever they stored due to the special condition of lockdown. So it will be anything if they are getting a compensation from the insurance company, it will be a revenue receipt because it is directly affecting the substitution of income. Now, another point is capital receipt if the amount is received from sale of capital asset or shares or debentures. See, I told you if you are selling a capital asset, most of the cases you will get a profit. See, if you are buying a house property, after few years, if you are selling that, you will get a profit. If you are buying a land, after few years, if you are selling, you will get a profit. Or if you are selling shares and debentures, if the capital market is good is moving good or it's giving good returns, then you can sell it at a higher rate. So that will be a capital receipt. Revenue receipt meaning if the amount is received from sale of goods, the day-to-day business. If you go to the supermarket or the hypermarket, so many customers will be going there. Now with this lockdown period also they are doing online sales also. So they will be getting sales from the customers. So that will be a revenue receipt for them every day. That is their business and they're making income out of that. Next point you have to remember, capital receipts are non-recurring in nature. I told you, I claimed 28 years I filed my tax returns. Right from the time I started working, I filed my tax returns. But only twice I reported capital gain. So capital receipts are not going to recur every day. Once in a while only we will get. So here I told you, if you buy a house property, you want to live in that house for so many years. After that only you will think about selling that. If you are able to gather money for buying a better house property, then you will think of selling that. So that is how you will get capital gain. Whereas revenue receipts are recurring in nature. A business organization without revenue receipt, they cannot survive. Every day they will be getting customers and they will be making profit out of that. The revenue receipts are every day, it's a recurring thing. Now, continuing with that, capital receipt is shown on the liability side of the balance sheet. Always you have to remember that. We are raising shares, we are raising capital, we are raising debentures. Everything we are writing on the liability side of the balance sheet. So that is the thing you have to remember. In the accounting treatment also it's different. So capital receipt we are showing on the liability side of the balance sheet. Whereas revenue receipt, you know that we are showing it in the profit and loss account. See, capital receipt is in the balance sheet, revenue receipt is in the profit and loss account. That also you have to remember, we are showing in the credit side of the profit and loss account. Credit side of the profit and loss account, we will write all the income or the receipts. So it will come in the credit side of the profit and loss account. Now, capital receipts are income generated from investment and financing activities of the firm. See, when you capital receipts, meaning you are investing in fixed asset, then you are generating an income. When you are buying a plant or machinery, you are utilizing that for manufacturing process. Then you are getting an income out of that. So from the fixed asset, you are generating income. Or if you are investing in capital, shares or debentures. So that is the financing activity. When you are getting finance, you are using that finance for running the business activities. You are making profit. That is how you will get capital receipt. Whereas revenue receipts are the income generated from the operating activities of the business. So if a business organization, if there's a bank, they will do the banking activities. If it's an insurance company, they will sell the insurance products. That is how they will get the revenue receipt. So any business activity, what all activity they are engaged in, so they will be doing that. If it's a restaurant, they will entertain customers and that is the revenue receipt for them. If Ola or Uber, they will run the taxi service and whatever the amount received from them will be their revenue receipt. This is the operating activity. What is the activity for which the business they started? That will be the revenue receipt. Whereas capital receipt is by financing activities. You are raising capital and you are using that. Or you are buying fixed asset. Then you are using that in your manufacturing process. That is how you are getting capital receipt. Now coming to the second point, capital expenses and revenue expenses. So here also you have to remember that capital receipts should be considered with capital expenses. Revenue income should be considered with revenue expenses. So capital expenses and revenue expenses distinction is also important. So capital expenses, you have to remember, expenses related to capital assets are capital expenditure. Say for example, if a business unit is buying a plant and machinery. So you have to remember that all of a sudden you cannot go and install and it will start generating revenue. That concept is wrong. You may have to construct a platform. You may have to keep a separate building for that. You may have to keep an air conditioner for that. You may have to keep a generator for that. So many related expenses are there. So anything related to that fixed asset, it will come under the capital expenditure. You have learned this concept in accounting also. When you buy a fixed asset, all the incidental expenses for making that asset in running condition, that will be a capital expenditure. Revenue expenses, expenses related to circulating assets are revenue expenditure. See for example, if I go to a hypermarket, then I can see that when I see the provision, butter, milk, all the cheese, everything, sausages, everything they have kept it in the fridge, air conditioner. Similarly, meat, fish, egg and all, they are keeping it in a separate, they need separate storage for that. They have to spend for that. Some hypermarkets are centrally air conditioned. So here you have to meet certain expenses for keeping that circulating asset in the condition, in good condition. So if you go to a supermarket, you can see that plastic items, there is no need for air conditioner and all. But whereas milk and milk related products, or fish, meat, egg, and all, they need separate storage for that, air conditioner or something like that. They have to take extra care, otherwise it will get spoiled. So these are the revenue expenses for a business organization. Capital expenditure, you have to remember that it's a long term expenditure. When you are buying a capital asset, you are going to utilize that for so many years. Your intention of buying that capital asset is not to sell immediately. You are going to use for long term. Revenue expenses, these are short term expenditure, because every day this circulating assets will keep changing. Customers will buy, they will change, they will replace the item. So the expenditure related to that item also will be changing. So it will keep changing. So it's short term expenditure. Every month they may have to pay the rent. Every month they may have to pay the electricity bill. Every month they may have to pay the security staff salary. They will have to do the central air condition expenses, they have to meet every month. So these are the short term expenditure. Whereas capital expenditure, it's for long term. Coming to the next point, capital expenses, expenses incurred for acquiring the asset or increasing the earning capacity of an existing asset is a capital expenditure. Say, for example, if I'll explain the ready-made or the dry cleaning unit. See, if we'll first, when he started with minimum capital. Imagine a person started with a minimum capital. So he went for, or he used semi-automatic machinery. Now, after doing the business, he started getting some profit. So what he will do, after few years, he will, from semi-automatic, he may change to fully automatic machine. So that is a capital expense. So why he's from semi-automatic, why he's going to fully automatic is he want to increase the earning capacity of his business. So he can save time. He can he can give better quality. He can give good service for the customers. So these are all capital expenses. Whereas revenue expenses, you have to remember, expenses incurred for the day-to-day activities of the business is a revenue expenditure. Salary for the staff, electricity bill, then salary for the security, parking expenses, parking lot expenses. Then all these related expenses are the revenue expenses. Advertisement expenses, manager's salary, salary to the staff, all these are revenue expenses. Now, coming to capital expenditure, if the expenditure is acquired as a source of income, it's a capital expenditure. Say, for example, purchasing a patent right or a copyright. Now, you know that the entire world is looking for a medicine for COVID-19. Imagine somebody got the good medicine, they invented the medicine for COVID-19. So, manufacturing companies will be competing with each other to purchase that right. They can manufacture and they can sell that. So that will be a capital expenditure, because that right they are going to utilize and they are going to mint money out of that, because now this is the thing they are going to buy, so that they know that if they purchase the right they can make money out of that. So that is it's a capital expenditure. It's a source of income. When they will get the COVID-19 medicine, if they'll get that patent right by a manufacturing company, then they can make money out of that. That is a capital expenditure. Revenue expenses, expenses for meeting the day-to-day activities of the business are revenue expenditure. I told you already, rent of the manager, rent for the building, rent, salary for the manager, rent for the building, advertisement expenses, electricity bill, parking lot expenses. So all this expenses can be revenue expenses. Now capital expenditure is incurred to improve the earning capacity of the business. So here you have to remember that if you're buying a plant and machinery, see I gave you the example of from semi-automatic, why you're going for fully automatic. You want to improve the earning capacity. See other competitors are doing that. So if you also provide that, you can attract the customers. You can give better quality service for your existing customers. Whereas revenue expenditure is incurred to maintain the earning capacity. See, your shop is not centrally air conditioned, but you know that if you have a hypermarket, other hypermarkets are centrally air conditioned. Customers prefer that. So you are also making it centrally air conditioned. So it's a revenue expenditure for the firm. So this, like that, any expenditure, see security, whatever security, existing security is not able to control the activities, because in a hypermarket they are getting more customers. So what they will do, they will change the security staff. That will be a revenue expenditure. They will give it to a more experienced security staff. The team of security will come and they will do the activities, or they will take the supervision. So that is a revenue expenditure. Now coming to the last point, capital losses and revenue losses. Capital losses, you have to remember, loss due to sale of a capital asset is a capital loss. Imagine if you are an educational institution, you got a school bus which you have used for 10 years. After that, if you want to sell that school bus, definitely you will get a loss only. So any loss due to a capital asset will be a capital loss. Whereas if you buy a house property or land and all, always appreciation will be there. Whereas in the case of vehicle and all, you will get always loss. So that is the any loss related to a capital asset is a capital loss. Revenue loss meaning loss due to sale of stock in trade is a revenue loss. Today when I went out, I saw that many shops they want to close down because they are not getting customers. Lockdown period, you have seen that many businesses have shut down. So there I can see that 70% stock clearance sale or they are going to. So that means they want to sell that stock and they want to get out of that business. It's a revenue loss. If the business was running, they would have made profit out of that. Now they are selling that and they are closing that business unit. It's a revenue loss. Next point you have to remember, amount deposited in the bank if withdrawn by an employee is a capital loss. This point is very, very important. The organization has deposited the money in the bank. From the bank, an employee, maybe forged signature or using the credit card, forged credit card, debit card, ATM card or anything like that, he is able to withdraw money from the bank, then it's a capital loss. Whereas if the same organization, from the organization, if an employee is able to take money out from the organization by any means, so that meaning by forged signature or when the cashier was not cashier when they went for a break or something, he forgot to lock the drawer, cash drawer, he took the money or something like that. If any employee is able to take money from the organization, then it will be revenue loss. Because within the organization, if cash misappropriation happens, it's a revenue loss. Whereas you have to remember that the organization is deposited in the bank. From the bank, if an employee has misappropriated money, then it will be a capital loss. Now we are coming to the next point. Loss due to natural calamities is a capital loss. If you had to remember that if it's sometimes natural calamities, Bhopal gas tragedy or Kerala floods, many organizations, they lost their entire, the stock they lost, their building collapsed, all that, many losses happened to them. So that is loss due to natural calamities is a capital loss. Whereas revenue loss, loss by fire of an unsecured asset is a revenue loss. See, always you have to remember that unsecured asset. If it's secured asset, meaning you have insurance for that. So if something happened to secured asset, you can go and claim the compensation from the insurance company. The organization will not suffer that much loss. Whereas here, a loss by fire, you have not secured that asset. Therefore, if some loss will happen, it will be a revenue loss. Next point you have to remember, issue of securities at a discount is a capital loss. Now you know that no company is going for capital issue because they know that they cannot sell that. People are not having money. Many people lost their job. They cannot sell the shares and securities. So you have to remember that if an organization is desperately looking for a capital investment or they want to raise funds from the capital market. So what they will do if face value is 10, they are forced to sell it at 8 rupees. It's a capital loss because they are not able to cover the face value also. Revenue loss meaning bad debts is a revenue loss. In business, you know that most of the transactions will happen on credit basis. Trustworthiness. So some business people, most of the business people are saying that they have to collect money from their customers, but they are not they are not able to give because lockdown has affected all the business activities. So bad debts is on the increase. So that is a revenue loss for the business organization. So this is what I want to explain. And then, so capital loss and revenue loss. So you have to remember that bad debts is a revenue loss. Now capital loss, one more point is there that I want to tell. Redemption of securities at a premium is a capital loss. See, first thing, last point what we have seen is below the face value they are issuing the shares or debentures. Here what happened is you have to redeem the securities. That meaning if you have issued the securities for 10 years, after 10 years you have to repay that. So you might have you might have agreed that if the face value is 10, you will be repaying at 50 rupees. But if you are forced to give it at a premium, more than the value, what you have expected, that meaning more than the value you have expected to redeem the securities, to repay the securities, you have to pay the premium price for that. It's a capital loss. Revenue loss meaning non-recovery of an amount from a customer is a revenue loss. So just like bad debts, you are giving on credit basis to a regular customer. Because if you ask the business people now, they will tell that so many customers, they defaulted the payment. They used to pay regularly, but all the businesses are affected. So sometimes, even if it's a good customer, good party for a business, good customer, he has got 100% assurance that he will be giving that money if it is in the regular condition. But this lockdown has forced him to make not able to make the payment. So non-recovery happens there. Then it's a revenue loss. This is the module about distinction between capital and revenue. I told you if you get questions, you will not get direct questions from this, but theory questions are important. Three main points we have learned with distinction. So I told you when you are asked to write distinction, always it's better to write it in the table format. And I told you for my explanation, I have used short forms for that explanation. I have not put it as full sentences. But please remember that when you are writing for the examination point of view, you have to convert it as full sentences and you have to write. So you can expect theory questions. Why this distinction is important between capital and revenue? Write the distinction between capital income, revenue income, capital expenses, revenue expenses, capital losses, revenue losses. And I hope this distinction is clear. And why this distinction is important also I told you. We have to distinguish whether that item should go to capital gain, head of income, or it should go to income from business or profession. So it's very, very important when we are doing the problems. Direct problems we are not doing, but this theoretical aspect is very, very important. I hope you understood that. And now we will come with the next module, so that till then you have to give me the feedback and your suggestions for improvement. And if you're happy with the modules, please let me know. That is the encouragement for doing the next module in a better way. So we have learned introduction for income tax, then the residential status computation, then this distinction between capital and revenue. So the next module I will come with incidence of tax. I told you there are three methods of treating. Resident tax liability will be different. Non-resident it will be different. Not ordinarily resident it will be different. So in the incidence of tax, the next module we are going to learn that how income is treated for these three. If he is a resident, not ordinarily resident and non-resident. So till then, see you, and I expect your feedback and suggestions. And if you have any questions, any queries, please raise that issue and I will be explaining that. Thank you for watching.